it would be interesting, just from a financial perspective, to get a little bit into this, like how you structured this project, and because that also relates very much to stablecoins, and I don't think everybody knows sort of what stablecoins are and how they work. And for me, I think what we'll also get into a little bit is what you mentioned, is that in the crypto sphere, there's this really strong, I think, drive to move back to commodity money. I guess it's also part of you because you mentioned it. But what you're doing now, to me, seems very much like private bank money creation, and you're building completely, as I understand it, on fiat. So I think there's an interesting tension there. I'll definitely give you the opportunity to resolve all of that. But what I wanted to do is share a little bit of a balance sheet that I built, because this is something that I do frequently on my channel. I try to explain how banking works through balance sheets, because I think that is a great way to clarify sort of what takes a lot of words to write down. So if I may share this with you and with everybody, then we can talk about that a little bit. But perhaps you can start while I set that up by just quickly going over the basics of what you have now. Let's start there, like the different types of tokens there are and how that works.
Yep, totally. So first off, the basic building block that powers the stablecoin that we have today is fiat-backed, US dollar-backed stablecoins. And the way that those work is essentially like a private version of a currency board, right? So you can bring one US dollar to the issuer, and they'll give you one fiat-backed stablecoin token on Ethereum or another blockchain. And then you can send that token around to anyone. Anyone can bring that token back to the issuer, and as long as they pass the KYC process, they can redeem it for one US dollar. And in practice, market makers tend to do that millions of dollars at a time, but that's the basic functionality of an ordinary US dollar-backed fiat-backed stablecoin.
Yeah.
The way that the reserve token works today is it's a little bit like, it's kind of like an ETF that's just backed by those fiat-backed stablecoins.
Can I quickly stop you? So you were talking about the reserve tokens just now, right?
Yes.
And they are a claim on the collateral tokens.
That's right.
Which are, I think, a claim on real assets, like USD treasuries, repo, perhaps.
Right now,
coins,
right now
right?
right now the collateral tokens are just a claim on US dollars. And so those stablecoin issuers, if you send them, 100,000 US dollars, they'll give you 100,000 stablecoins. And then they might take those assets and, purchase treasuries or something that's interest bearing, right? That's their business model, is to earn some amount of return on that underlying collateral capital that you've sent them. Mm-hmm. But when you redeem them, you're just redeeming for US dollar cash.
Yeah. All right. So I think I've drawn that out a little bit. So your collateral tokens are based on USD type coins, other stable coins, and they are then based on treasury repo. And your reserve tokens are basically a claim on these collateral tokens.
Yep, that's right.
Okay, excellent.
Right.
And go ahead.
And well, I think there's a natural question there of like, well, why? Like, what's the point? Why not just use those US dollar stablecoins directly? So just one piece of context there is that it makes it so that we're not dependent on any particular of those stablecoin issuers, because if any one of them were to, say, run into a regulatory roadblock and decide to shut down, or they decided that their system would be permissioned and couldn't be used permissionlessly, for example, then that portion of the collateral tokens could be traded out for other stablecoins of equivalent value. So it means that we can create this end user token, the reserve token, that people use in our app and they can use in the crypto ecosystem. And that can continue to have the same value, even if those sort of middleware level fiat-backed stablecoins have to be swapped out for some reason or another over the next 5 years or something.
Yeah. All right. Okay. I think that makes sense. I'm glad you mentioned that because I didn't yet read that. But I think you also have plans to transition very quickly to just buying in a decentralized way these types of assets yourself, right? Is that correct?
So yeah. So the thing is, we don't ever want to have like a stable coin that people are expecting to be backed by one type of thing, suddenly switch and be backed by something else. So the current stable coin that's backed by these US dollar stable coins should always stay that way. But we can issue additional stable coins. And actually, our smart contracts can be used by anyone to issue additional stable coins. And so that means that you can create, let me tell you about the next one that we're excited to deploy in sometime at the end of this year or early next year. Well, I guess this goes pretty deep down the crypto rabbit hole, depending on whether you know much about DeFi or not. But I think that you'll understand it even if not. So in DeFi, you can lend out your US dollar stablecoins trustlessly, like on Ethereum, where what happens is you deposit your stablecoins into a smart contract, and then someone else can come and borrow those stablecoins by posting volatile assets like ETH, for example, as collateral. And you can generate some amount of interest on that. Like right now, maybe it's around 5% per year or something, lending out your stable coins in that trustless way. Well, the next version, the next stablecoin that we'll issue, instead of being backed directly by US dollar stablecoins, it's actually backed by tokens that are produced by these lending protocols like Compound and Aave, and those tokens are a claim on the underlying stable coins that got lent out through those lending protocols, including any interest that's been generated. And so you add this further step of indirection.
So exactly. Can I just pause you there quickly and see if I'm still with you? So you're working on these reserve tokens. I just called them version 2. Right, and they are meant to be lent out with collateral, or there should be collateral on these loans. Is that correct?
Yeah. So let me explain it like a little bit mechanistically, just to make sure that it's clear, because it's a little bit counterintuitive. So, if you go to Compound right now and you deposit 100 USDC,
what is Compound?
You will get a Compound. Okay, so Compound is a decentralized lending protocol. It's super interesting. The way that it works is you can go and deposit stable coins. For example, USDC is like a very popular and safe stablecoin you could use on Compound. And you're basically saying, okay, it's kind of like putting your money into a bank, and then the bank is going to lend out the money, except in this case, the bank is just a smart contract. And so the bank doesn't do any credit worthiness assessment of individuals. It doesn't know anything about the individuals who are borrowing. And that might sound completely crazy, except that all of the loans that it makes are over collateralized.
Right.
And
this is not crazy at all. This is very much how repo works. And also how, for example, asset-backed securities work. So this is something that is where a lot of sort of scholars are working on what they call market-based banking, which is actually a feature, something that I just taught in one of my courses, where this also happens. That because you have this collateral, and it's typically also in repo over collateralized, they call it a haircut. Meaning that you get less money than what you post in collateral. So this and then the consequence of that is that banks no longer have to do sort of the credit check, because they're very confident that they can always get their money back. It's very similar, right?
Excellent. Yes, very similar. Yeah, it's basically the exact same principle. So yeah, except the thing is, the borrowers in a system like Compound are generally crypto speculators who want to go like, they want to take a leveraged long position on their assets. So they could go and deposit, for example, some Ethereum as collateral, and borrow stablecoins, and then go buy more ETH. And that's a common use case for these lending protocols. And because of that, the interest rates that you get to lend out your stablecoins through these protocols tend to follow crypto market cycles. If the crypto market is bullish, lots of people want to go margin long, and so they'll pay you a lot to borrow your stablecoins. And if the crypto markets are down, then the rates will be a lot lower because people aren't as excited about gambling on crypto assets.
Yeah. Okay, I see. Yeah. So the yields there are very much tied to the profits that are just being made in crypto.
Yep.
Yep. Okay. Excellent.
And so then the way that this works then is like you can go deposit your stablecoins into, say, Compound, and that gives you these your balance gets tokenized. Unlike a bank account, you now have a token that you can send to me, and then I could go redeem that token with Compound to get out the underlying stablecoins plus the interest that's been earned. And so once you get those tokens that represent that balance, you can actually go then mint this new reserve stablecoin by depositing those tokens instead of depositing stablecoins directly. So it's not that people deposit stablecoins into reserve and the reserve goes and talks to Compound. Instead, it's that the person who's minting that new kind of reserve token, they have to have already created those deposits within Compound or another protocol called Aave, and then they take those tokens that represent those balances and they go deposit them to mint the reserve stablecoin. And the net effect of that is that the reserve stablecoin is now backed by those positions in those lending protocols. And so then that reserve stablecoin is automatically accruing whatever interest is accrued to those balances.
Okay, but so let me just try to recap that a little bit, because I think for an economist like myself, this was all very fast with a lot of terms that are quite foreign to me. But was this your description of how sort of the lend out tokens, what they do, or was this also your description of what's happening on your liability side of the reserve protocol itself?
Yeah, so let's see if I can put it in clearer terms. So the liability for this reserve token V2, as you've labeled it, is for I use the term DeFi bearer instruments or bearer assets, because these tokens that you get out of Compound when you've created a position, they're bearer instruments in that you can send them to anyone and anyone can then redeem them for the underlying stable coins that you initially deposited into that lending protocol along with any interest.
Okay, so can I just quickly interrupt you to make sure that I'm still following? If I want to get your reserve tokens V2, I deposit stablecoins, not USD. Is that correct?
Yeah. So you like if you started off with USD, you could go to the stablecoin issuers and issue the initial stablecoins. Then you could take those stablecoins and go to Compound and deposit them into Compound to get those tokens that represent Compound positions. And then you could go deposit those into the reserve protocol to get this new reserve stablecoin.
Okay, excellent. And then, what you do with the stablecoins that have been deposited is you lend them out again. Is that correct?
Well, no. So that's the interesting thing. Because the tokens that get deposited into the reserve smart contract represent balances of stablecoins that have already been made available to borrow through Compound. So that means that our protocol doesn't actually do any lending. Our protocol is still doing the same thing as it is in the first reserve token case. It's just holding those tokens and making them available to redeem. But those, you see what I'm saying. So like the lending is already happening in a different smart contract.
Yeah. Okay. So that is so I need to change this. These are these other USD stablecoins directly. These USD coins already lent out.
And so I don't know if it will make it clearer or less clear, but Compound has like a naming convention, for example, where if you have a token, say DAI, like DAI is a popular stablecoin, DAI.
Yeah.
If you deposit DAI into Compound, you get a token that's called CDAI, like lowercase c and then DAI. And so our protocol wouldn't hold DAI; it would hold CDAI for the reserve token V2.
Okay, so like C DAI. Can I say that? So you have, that's the asset that your reserve token V2 is a claim on.
Right. That's right.
Okay. Excellent. Okay.
And a basket of different such assets, but yeah.
Yeah. And then I'll just end the like. Okay. That's really interesting. So this is new for me. It does still remind me a lot of what's happening in repo markets or asset-backed security markets.